This is the Alts Insights podcast with Sherri Cooke of AI Insight. Today, I'll do a review of the trends we're seeing in the non-traded alts industry, as well as some of the market insights relevant to each category. Laura Sexton, Senior Director of Program Management here at AI Insight, is joining us to discuss the key findings and some market insights with us. Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market. This is Sherri Cooke, CEO of AI Insight, and today I'm here with Laura Sexton, Senior Director of Program Management at AI Insight, to talk about the 4 new industry reports we've released in the last month, all of which are available to subscribers on AIinsight.com. We publish 26 reports annually covering all of the key non-traded categories and the alternative strategy mutual funds. Laura, let's start with the non-traded REIT segment and some insights from our Q1 non-traded REIT industry report, which is released quarterly.
Sure. One of the largest takeaways, I think, from the data from the first quarter was that the worst appears to be over for non-traded REITs in terms of capital raise, at least according to what the numbers are telling us. The category posted one of its best quarters in recent years, raising over $1.5 billion in the first quarter. 2017 was likely the bottom, a year in which active non-traded REITs raised a total of $3.5 billion. So this year, the industry is certainly on track to exceed that year and already exceeds 2018 capital raised by about $500 million. I think the other interesting point from the numbers is that while Blackstone maintained its leadership position, its share of the raise actually declined from about 63% of the total capital raised in 2018 to about 58% of total capital raised in Q1. So the total raise has increased, and the concentration in one sponsor has declined, which speaks to a healthier industry overall, not so concentrated in one sponsor. But we'll be watching it closely over the next couple of quarterlies, and ideally we see this trend continue. Outside of the non-traded industry, capital raise has also been strong. For example, Bain Capital got into the real estate market through hiring a team from Harvard's endowment in 2018, and their fund actually raised $1.5 billion, which is $500,000 over their original $1 billion target. That fund is looking to invest in life sciences buildings, storage, and seniors housing, but a good raise there, which is a good sign for real estate, despite kind of all the run-up in pricing in real estate. So the traded REIT markets are posting some strong performance too, which I think lends itself to stronger raised trends on the non-traded side. Actually, traded REITs are outperforming equities by 160 basis points as of Friday's close in a strong equity year. Traded REITs are up 21.4% versus 19.8% for the S&P.
Have you noticed any major shifts in the industry, either recently or long-term?
Sure. Another trend worth highlighting is the focus in the industry now on perpetual life non-traded REITs, or those that offer shares and reprice continually with no specific liquidity event planned. These represented 80% of the capital raised in the first quarter, which of course is partially due to the fact that Blackstone falls into this category. But you also have several others, Starwood, Jones Lang LaSalle in this group gaining a little more traction. What's interesting is that there seems to be more of a focus on bringing this structure and strategy to the non-traded industry, which has always been in place on the institutional side for many years. Now you have these larger, continual, diversified non-traded REITs, which kind of serve as core real estate exposure, and then the new generation of the life cycle REITs, or those that have a defined lifespan, that seem to be smaller and focus more specifically on a sector or strategy. And I think this speaks to some of the lessons learned from the prior real estate cycle as the non-traded REIT industry matures, that maybe the life cycle structure works better for smaller, more focused strategies, while the perpetual strategy works better for larger, more diversified funds. Smaller funds in the $2 to $4 billion range that focus on a specific strategy or sector tend to have better liquidity options and can hone in on finding a niche that larger players may want to buy, a consolidated portfolio that they might want to buy, whereas the larger, more diversified options may be better managed ongoing, since it's more difficult, as we've seen, to liquidate a diversified, let's say, $10 billion fund. You just don't have as many options. So for advisors looking to position real estate, the way to think about this would be to kind of use the perpetual life diversified funds for your core real estate exposure, with a life cycle REITs for more growth-oriented opportunities for clients who maybe have a higher risk tolerance or are looking to capitalize on specific trends such as student housing, hospitality, or seniors housing. It's the same thing as kind of the core satellite approach, which is commonly used on the traditional investing side as well.
Laura, that's great. That's really, really helpful, I think, as advisors are trying to determine how best to utilize these types of investments with their clients. Okay, so let's move on now to private placements and the trends we're seeing there. The retail alt space has always had an overweight to real estate programs. Is that still the case? And if so, how are the categories doing?
Sure. The biggest trend here on the private placement side is that we're seeing a continued focus on 1031 exchanges and other real estate private placements, including opportunity zones, which we'll discuss, and a little less fund formation and what we would call kind of the niche strategies, such as energy, preferred securities, private equity and debt, and conservation easements. As you said, our coverage is typically weighted to real estate programs, and it is in the retail world, but there's always been steady formation of the other niche funds. We're just not seeing that this year.
Okay. So what's happening then with those niche categories, and why have they slowed?
Sure. So let's take energy, for example, which was always pretty consistent and around, we would see about 20 to 25 funds each year, offered each year, prior to the fall in energy prices in 2014, which really was the peak in fund formation and target raise, of course, going along with the peak in oil prices. And since then has been roughly about half of that in terms of fund formation. This year, in 2019, we've only seen 4 new energy funds, mostly focused on oil and gas drilling and development, which is where the funds we cover usually focus, kind of the development and drilling aspect. It's relatively growth-focused, and as of right now, we're not seeing new funds coming soon, so certainly, not a great year in terms of fund formation for energy. The sector does ramp up in the second half of the year due to its tax benefits, so we could see a little bit of a ramp up, but we're behind even on a year-over-year basis compared to last year. I will say it's not surprising that after a major market downturn in a sector like we saw in 2014, crude oil prices fell that year from over $100 a barrel to the mid-40s. So, of course, you're going to see a little bit of a reset in an industry, maybe fewer programs. What's interesting here is how long this recovery has taken. Obviously, we've seen a partial recovery in oil prices, and many think the worst is over. Crude is trading around $60 a barrel now. But you also have other factors coming into play that are keeping companies from investing in growth especially, which, again, as I mentioned, is where a lot of the programs that we see focused on. There's a fear of tariffs coming into play, which could impact costs for oil and gas companies and could put pressure on consumers, kind of a double whammy for the energy industry and a lot of uncertainty around it. Sustainability is another factor, which is becoming more of a mainstream discussion rather than a niche, and even more so in countries such as China, which has a big impact on global energy demand. And then technology is the other factor impacting the industry. New technologies are impacting the entire supply chain. In an industry that was really local, often family-focused, you'd have generations of families where specific techniques were passed down from person to person. They're really having to relook at how they run their businesses and embrace technology, because if they don't, they're going to be priced right out of the market. So besides the major downturn in the oil market in 2014, there are many factors holding this industry back. But on the flip side, if you look at any energy report out there, you continue to see the mention of higher quality deals, better cost containment, better operational awareness, more sustainable returns and capital discipline. So there are fewer funds, but with healthier overall economics.
Yeah, I don't think anybody would dispute we're in uncharted waters these days, relative to what's going on, in the economy and the world, really. But I think it really just does focus on how important it is to really dig down deep and understand these programs. So,
right.
So that's really helpful. Thanks. Okay, so you mentioned opportunity zones. I know we've seen 8 of these so far this year added to our coverage with a target of almost $1.7 billion. Certainly been a lot of buzz about these. Conceptually, they're definitely interesting and offer a lot of sizzle from a marketing perspective, but no doubt pretty complex. So what insights do the numbers tell us so far with regard to these kinds of programs?
Yeah, definitely a lot of buzz around opportunity zones. And the larger funds are quite large. I'd say more so than the typical private placement. Fund sizes range from the smaller, more targeted funds looking at specific opportunities around $30 million to the larger, more diversified programs targeting $500 million or so in capital range. In capital raise range. The 8 funds we cover have an aggregate target raise of $1.7 billion, and so far have reported an aggregate raise of just under $200 million, which is about 12% of their target. So this is going to be something to watch very, very closely, and anyone investing in these funds or looking at them is going to want to watch the capital raise closely, because in order to meet the regulatory requirements to maintain their opportunity zone status, these funds need to raise capital relatively quickly and invest quickly, which so far hasn't necessarily been the case in our coverage universe, at least, and it seems so beyond this, too. So CoStar just released an article about opportunity zones, actually, saying that of the total 160 funds registered with the SEC, which have an aggregate target raise of about $15.5 billion, they've raised about $1.6 billion in aggregate, or less than 10% of their target raise. So what we're seeing in the broker-dealer RIA world seems to be pretty consistent with what's happening in the broader alts market as well. These funds are very complex. They do need to be carefully vetted and monitored. I would say for those who want to listen to another good podcast, one good one out there for folks to listen to is the Awesome Wholesaler Experience podcast interview with Brian Mick of Mick & Associates. Look that one up and listen. It's an interesting talk on opportunity zones and other non-traded alts with some good insights on things to monitor.
Great. Yeah, I did have an opportunity to listen to that, and I found it to be very very helpful and great detail. You've covered non-traded REITs and private placements. So what are the other reports that we've released and the key findings from these?
Yeah, so the other reports include the first quarter non-traded BDC report and the 2018 fiscal year-end interval fund report. The key highlights in the BDC report really is the continued decline in fund formation here, and mergers of some of the earlier programs in favor of formation in the more flexible interval fund structure. Most of the early BDC sponsors have moved to the interval fund structure, including Franklin Square, who we know sponsored the first non-traded BDC back in 2009. In terms of interval funds, there's currently 60 active interval funds, and this is massive growth from a few years ago. At the beginning of 2014, there were only 16 of these funds. Griffin and Sherri's Post were 2 of the first in our space to launch funds that year. In 2017 and 18, you saw 10 and 12 new funds launched. And this year in 2019, there's already 7 new funds that have gone effective and another 20 in registration. So the funds are focused primarily on credit and loan strategies, again, because some of those earlier BDC funds are moving towards this structure. It makes sense. And then real estate is the other large sector weighting within the interval fund. Interval funds are also different. They're very flexible and can own just about anything, so you really have to diligence them initially and ongoing to see what they're actually doing. And you have to make sure you're comparing apples to apples in performance and metrics. So returns for interval funds overall declined between 2016 and 2018, but there's a huge disparity in returns within the space. So taking the average for a category so broad is only useful as a starting point. You want to make sure to analyze the funds by strategy, which will give you a better indication of performance, which is something we do in our industry reports.
That's great. Laura, thanks so much, because I know interval funds are certainly a point of real focus, and rightfully so, and are front and center right now. So that was all really helpful information. Thanks so much. So let's switch directions just a little bit. Given the fact that our coverage is always been historically weighted to real estate, let's just kind of walk through the fundamentals of the 4 primary real estate categories, just to kind of get a pulse on how things are going and maybe give a little insight into exposure in the alts world to these sectors.
Sure. Yeah. So why don't I start with the 2 sectors most impacted by technology and millennials, which I always think are interesting topics. So, retail. I'll start with retail. Retail economics are definitely slow but positive overall. But the main theme here in retail is that they continue to be very highly bifurcated. According to Reese, their recent report for Q1, absorption, occupancy, and rents are all improving across the whole retail spectrum and have been for the last 4 quarters. But they cover 80 metros, and of those 80 metros they track, they've actually seen declining fundamentals in 49 of them, which means that you have very strong fundamentals kicking in for the best markets, but continued weakness in the worst. So highly bifurcated. I mean, usually by this point in a real estate cycle, you've seen a narrowing of the performance between markets. But this bifurcation really speaks to the long-term fundamental changes in the retail space because of technologies and habits of the millennials. They want more experience, a little less on the traditional retail. So some fundamental changes that are going to be around for the long term. Malls are another area of continued weakness where you see vacancy and rates continue to increase. I know PricewaterhouseCoopers just released a new report saying they expect malls to continue to weaken, growth to continue to decline in the mall space, but neighborhood and community shopping centers actually seem to be holding up better. Retail had a much bigger presence in the non-traded world in the first generation of the non-traded REITs and 1031s, but much less so now in favor of multifamily and to some extent industrial. The traded REIT markets are actually much more heavily weighted to retail at about 16% of the total market cap of the NAREIT index. It's still the largest sector in this index, which I think speaks to the fact that there's still a lot of retail properties in the U.S., more so than what's needed, and part of the reason for the continued struggles in this industry. So now switching gears to office, another one clearly impacted by millennials and technology. Office fundamentals were steadily increasing, but seem to be flattening again. They're sort of stuck in this pattern of improvement. Looks like they improve for a few quarters and then they slip again with new supply coming online. This is actually expected probably to happen again over the next 12 months. You've seen some positive rent growth, again, highly bifurcated, but there's a decent amount of supply coming online later this year, so you can see flattening again. Vacancy dipped to just above 16% early in 2017, but it's come back. It's hovering around the mid 16% over the last couple of quarters, so a little bit of improvement. But actually, it's only 100 basis points. And this is what's interesting here, that it's only 100 basis points difference from the cyclical vacancy peak in 2010, which means that the market has seen minimal overall improvement in basically the entire recovery period, where you've had great real estate performance in almost every other sector, and despite this growing economic backdrop. So, I mean, what happens to the sector when the economy actually slows if this is the performance it's going to exhibit during economic growth? It's an interesting one to watch. And office is another sector significantly impacted by technology and by the millennials, and it is absolutely the same as retail in terms of its bifurcation. The gap between the healthier and weaker markets continues to widen, as does the performance of Class A assets, which have seen positive fundamental growth, and Class B and C assets, which have actually seen declining fundamentals. Co-working, technology, finance, and insurance actually lead the leasing activity for new space. And I want to point out co-working, the WeWork and the WeWorks of the world basically are something that basically had no presence in the top leasing arena a few years ago. It's the leader. They're the leader in terms of leasing new office space for the last few quarters. And I think this is something to watch because this is a business model that's pretty dependent on economic growth. I mean, you've got more leasing, more co-working in an economic growth cycle, and so in a downturn, you could see impact. This could impact the space even more, given how much has been leased to this type of business. So really something to watch, given that this is the top leasing activity we've seen. And again, office is another area that used to have much more of a presence in the non-traded space, but now is really only in the larger, more diversified funds, the daily NAV funds, and those ones are more focused on the core stabilized assets in Class A markets, and so some of the more value-added office players, such as KBS, that used to be in the non-traded market, have gotten out of the non-traded space and have gone back to what they were doing before in terms of smaller private placements, which actually may be a better structure for these types of assets, value-added office. They tend to be very illiquid, so maybe a better structure for them. That's kind of what's going on in office.
It's really interesting, though, as we step back and, get some high-level perspectives, or we look at some of these trends, just to kind of see the indicators. And it comes back again and again that we are all operating in what's becoming a new normal. And those new normals are a lot shorter-lived. So really, really interesting. So thanks for sharing on, some insight on that. So can you tell us just a little bit about industrial and apartments and, the two of the stronger sectors that you're seeing here? We'll dive a little deeper into those for us.
Sure. Yeah. I mean, industrial fundamentals Definitely a very, very strong sector, especially in this recovery, as we all know, with e-commerce really, benefiting this industry almost better than any of the others. So industrial fundamentals have slowed. This is primarily due to supply coming online. One thing about industrial supply, it's hard to predict. They're easy to build assets, and supply turnaround can be really quick. I mean, unlike an office building, which can take years to build, you can build an industrial property relatively quickly. So the supply is very hard to predict, longer than, a few months out. So a little bit of weakness now just due to supply, but still really strong fundamentals here. The other aspect you have going on, the tariff uncertainties have been a factor recently, causing a little bit of a slowdown in fundamentals. But actually, this may be good for long-term fundamentals, as actually you might see less building happening over the next 12 months. It's kind of keeping people from building too much, a little uncertainty. The sector is actually one of the few that actually continues to benefit, obviously, from the internet and technology. No deceleration expected in that anytime soon. So, I think the outlook for industrial is for kind of slowing, but continued favorable fundamentals for the sector. Again, though, make sure you got to really underwrite these closely, because it's a tough one to forecast. The supply can ramp up so quickly. Something to be cautious of. Apartments are another really interesting sector. A lot of buzz around them. A lot of time has been spent trying to determine if the preference for apartment living versus owning is a long-term trend, or if it's one caused by the millennials and higher financing costs after the downturn. Both of those, which are kind of impermanent, but is it a long-term trend towards apartment living? Overall, apartments are definitely one of the healthier sectors, other than industrial. Even though fundamentals have slowed, cap rates have kind of come back up just a little bit. The vacancy rates are still only in the upper 4% range after bottoming out at just over about 4% in 2016. That's kind of the peak of the market. And they're still below, even with all the new supply we've all seen, the vacancy is still below the long-term average of 5.2%. Amazingly, again, this is on the heels of record new construction. I mean, in any other sector, the amount of construction seen in apartments would have killed the sector long ago, but the demand for apartments and the difficulty and expense of buying a house now are such strong factors that vacancies have just modestly increased. According to Reese, if all the projects in place now in 2019 are completed, this will be the highest number of new completions on record in at least 20 years, but yet they're still forecasting strong fundamentals and even an acceleration in rent growth. So pretty positive fundamentals to offset such a high amount of building. Another positive factor is here in this sector is how much less bifurcated the market is. So unlike retail and office, only a few metros saw vacancies increase for apartments. So the recovery, unlike the other sectors that have been more bifurcated, has actually been fairly balanced, which is better and speaks to a healthier market. In terms of exposure, the non-traded REITs that focus on apartments are now actually out of the market, and we haven't seen too many new ones because the cap rates in the sector have declined so much. The diversified non-traded REITs certainly have a meaningful allocation to them, but again, they're really focused on kind of the highest quality, which will be in the lower yielding markets. One area to note here in terms of exposure is the 1031 markets, which are very much exposed to multifamily. Of the 1031 funds that have been added to our coverage this year, which can be seen in the private placement report, 55% of the target capital there is in multifamily. So they're definitely looking to raise for multifamily. I'd say for investors and advisors, the good thing is for apartments, fundamentals are pretty strong despite all the new construction, but you just want to make sure that the properties are very well underwritten in all different scenarios, cap rates going up, down, different levels of income, higher costs, things like that. All the different scenarios have been considered. Make sure they're carefully underwritten.
Okay, great. Laura, thank you so much for sharing those insights. Listeners, thanks for spending time with us today. And be sure and check out our website, AIinsight.com, for information on how to subscribe to all of our industry reports. That is what Laura has been drawing from today, and will continue to do in the future. So check out those and also other tools that can help you stay ahead of the alt industry. Take care.